Hello, good day. My name is Hussein and I'm Forex Optimum Broker Financial Analyst. I'm back again to bring you all new updates in the financial markets. First of all, I would like to talk about the tension is rising on financial markets, though it is so unclear external appearance on Monday. However, even in this low volatility, investors are still could be spotted the US 10-year Treasury yield as holding above a 1.60%, nudging the US dollar to strengthen. The broad market S&P 500 index was stumbling, trading around 3,940 points. Crude prices were down by almost 1%, and gold prices as a safe haven assets were rising. Reasons of such concerns are clear. Long-term interest rates are rising. Inflation is expected at about 2 to 3% in 2021, while Federal Reserve Jerome Powell is demonstrating about enduring tranquility. Fascinating courage, if not a dummy sham performed by Mr. Powell that investors may expose ahead of Fed meeting this week. Investors just need to raise 10 years bond yields to 1.65% to 1.70%, or 13 weeks high, and Mr. Powell would be forced to comment on this matter on his follow-up press briefing. If he reiterates once more that he's not concerned with this, investors would receive a clear signal for early tightening of Fed monetary policy with the following sell-offs in the stock market. If Fed Chairman Jerome Powell indeed would express his concern over rising yields, that would mean Mr. Powell was towing the market when he brushed off concerns that a move up in yields might spell trouble for the Fed. This could also mean that the Fed is ready to initiate yield curve control to soften monetary policy. The Fed might also revise its macroeconomic outlook after the approval of 1.9 trillion relief bill to update its trajectory for interest rates changes. So this is another risk factor that may boost yields even further and trigger the correction in the stock market. So the choice Fed has to make is indeed serious. The more likely option for the Fed is to avoid any changes in its current policy. However, such choice may signal a steep correction for the US stock market that would prompt the Fed to deliver additional stimulus measures. The US stock market is likely to take a pause in such equivocal situation, or even to decline a little within the range of 3,900 to 3,950 points. If the S&P 500 market index would sustain above 3,900 points after Fed meeting, we may consider a further rally to 4,000 points as most likely. Also, having a look on the oil market, which is waiting for Fed decision and possible US-Iran talks. If rumors of re-establishing nuclear deal would be confirmed, crude prices would suffer as 2 million barrels a day will return to the global market. Technically, the important support level for Brent crude is at about $68.60. In this case, it would be broken. Prices may drop to $65 per barrel within this week. If this support level was sustained, then the primary scenario would be a recovery to 69.75 or 70.70 per barrel. Gold prices are following US debt market movements. So if the Fed would refrain to cap rising yields this week, then the pressure on gold prices would strengthen. In this case, price targets at $1,400 to $1,450 per troy ounce could be closer than expected. The greenback is gaining momentum, pressuring other currencies. The Euro USD this week may slip to 1.15 this week after the pair fell way below key support level of 1.19, which was broken. The same situation is in GBP USD after the pair lost crown below 1.39150. If the pair fall or fail below to recover, this will be a quickly a level to be tested, then to decline to 1.3510 would become a priority. The USD JPY is close to begin a reversal movement, although it might reach the level of 110.50, but this is totally unnecessary. If the stock market would return for a correction, the pay may descend to the support level of 106.50. That's all for the day. Thank you very much for listening and have a great profitable trading week.